Hello students, welcome to week 1 of Accounting Principles. I hope and pray your week is going well. One of the videos I distribute each week for my online courses is a mini lecture. That's this one. The mini lecture gives you an overview of what's coming your way during the upcoming week while briefly hitting some of the important concepts of the text. Now these video mini lectures are not comprehensive and they're really meant to point you in the right direction, not to give you all the details. So make sure you're reading and digesting the assigned material um, while meeting the weekly learning objectives so you can meet those weekly learning objectives. So let's take a look at our objectives for week 1. This week we're looking at describing the major internal control components of the accounting system. Specifically, we're looking at the control activities for merchandising transactions, at least for this week. Transactions around cash, receipts, credit cards and debit cards and that sort of thing. We're also looking at the role of management and the accounting auditor in the internal control activities. When we talk about internal controls of accounting, one of the primary characteristics that we look at, we're referring to is faithful representation. So in short, faithful representation is the characteristic of truthfulness, meaning that financial information is complete, accurate, and not biased. Now, the intent of faithful representation is to be able to allow uses of the financial system, uh, allow users of the financial system to know their decision making is based on solid and truthful information. And as believers in Christ, we want to make sure that we're always providing accurate information to people and being truthful about it. Okay, so the internal controls process allow businesses to achieve that faithful representation characteristic of their financial system. So let's talk about some of the internal controls for a second. There are 5 major components of the internal controls that help us to achieve this faithful representation characteristics. That is, the control environment is one of those components, the risk assessment, the control activities themselves. Information and communication is one of those components, as well as monitoring of the output from the accounting system. So be sure to read about these details in the course chapter, the internal control activities and the internal control components. All right. For merchandising transactions, an internal control system can help with preventing inventory losses. It can help with making sure cash register balances are accurate, and the internal control systems can make sure that there's enough cash available in the bank accounts rather, to pay suppliers and pay your employees, to name just a few. One of the easiest ways to lose control of the accounting system, especially merchandising, is through the handling of cash receipts. It's too easy for employees, visitors, or others to simply be tempted to and even take cash without being found out. So there are 2 easily implementable solutions to help reduce the loss of cash. First, whenever cash is received, it should be recorded in the cash receipts journal. And second, when cash is received by mail, make sure the transactions are recorded and copied 3 times, one for the employee, one for the vault, and another one for the accounting department. It's also important in avoiding theft of cash and outgoing payments of cash need to be specifically authorized and documented. So before cash goes out the door, someone needs to approve that. Separating the duties of people who handle cash is an important step in preventing theft. Now, this can be a challenge in a smaller company where there are limited people, but small businesses must do their best to separate the duties of those people who handle cash. Separation of duties will protect the businesses from theft and the employees from accusations of theft. In this busy little chart here, this is an overview of the internal controls framework at a larger company. Now notice in the green shaded boxes, look at all the separation of duties in a typical business. This sort of internal control makes it very difficult for cash to just disappear. And in 2002, we're going to talk just about ethics for a second. The Congress passed the Sarbanes-Oxley Act after two major accounting fraud events in the U.S. Fraud at WorldCom and Enron. You've probably heard about the Enron but turned exposed. They exposed those frauds, exposed the gap in the internal control systems legislation. So, where top level management could not always be trusted to do the right thing, or they were not aware of the faithful representation of their own financial reports. People were giving them fraudulent information, top level managers, and they didn't even know it. You can read more about these two scandals online, but just know that Sarbanes actually closed the gap in the internal control system. Okay, that's it for now. Remember to get your quizzes and discussion questions done on time. And remember, God is on his throne. He's always been there and he's always going to be. Have a great week.